Hi guys, it's your favourite YouTuber again, Dami Solari, and you're watching DSN and Finance. Whoa. Now there's a huge list of questions that every investor should know the answers to before they invest in a particular company. But I've done you guys a favour and narrowed them down. You know what to do, keep watching. First, to be honest, this is self-explanatory. You guys might laugh at this, but you'll be surprised how many investors actually blindly put their money into a company without actually knowing this fundamental information. What does the company do? You need to know what exactly they do. There's no point just blindly following the financials and not knowing actually what they sell. They could be selling drugs, they could be a shell company, they could be a legal company within a shell company, they can be different types of umbrellas under which they can fall within, and you therefore need to make sure that you know what that company is doing in and out. I understand you're probably laughing thinking that, oh, this is pretty simple, but you'll be surprised how many stupid investors, and I use that word selectively, stupid investors, blindly follow something on a whim without actually knowing that crucial information, what the company does. This question you need to know the answer to when investing in a stock is, what is the market sector that that company belongs to, and also how is that market sector progressing in the future. This is pivotal. Why? Because you can have a beautiful company, you can have a wonderful company that's got all the right things going for it, but if the market sector is shrinking and shrinking and shrinking, then guess what? That company is going to shrink and shrink and shrink. But ultimately, the market under which that company falls within is the life force. It dictates whether that company is going to survive or not. So what you always want to ensure is that whether a company is looking like a wonderful investment or whether it's looking like a poor investment, its market is increasing and its market will always be there for the future, years and years to come. That's what you want as an investor. Now, the third question that you need to know the answer to, that you should ask yourself whenever you're investing in a company is, does the company pay dividends, and also has its dividends been rising year after year? I'll tell you what, dividends, as I've discussed previously numerous amounts of times in my videos, is free money from the company to you as an investor for saying thank you for trusting us, thank you for investing in us. That's what dividends is. So in other words, dividends is a luxury. It's expendable cost for the business. It's them taking money out of their own pockets and rewarding you for investing in them. So dividends can be a very good indication of where that company stands. If a company has its dividends increasing year after year after year, then that is excellent, because that highly implies that that company is doing well year after year after year. On the flip side, if the company's decreasing their dividends, then that could mean that they're taking away that money, that luxury that they're trying to pay you, that they're trying to reward you for, and therefore they're using it to probably help the business back up again. So you want to make sure that your dividends is increasing year after year consistently, because that's a really good indication. Now, every company in the world has some form of debt. It may not be a lot, it may be a lot. Obviously you want to minimize the debt and you want to maximize the profits. So with that said, that's the next question. What is the company's debt? This is pretty much self-explanatory, as you guys probably know. You want to minimize debt and you want to increase profits. With that said, there are exceptions. The oil and gas industry and mining companies tend to be very big exceptions, because these companies tend to rely heavily on sourcing those raw materials, sourcing the oil, sourcing the gold, or whatever they're looking to mine. So the actual profitability of the company is heavily dependent on that, and therefore they tend to take up a lot of huge steps initially for that reward in the future. and that's understandable. But be careful, because some companies don't explicitly use the word debt. They could use the word borrowings, deficit. There's a million other different words to use that all fall within that, under that umbrella, debt. So be wary of that, guys, and don't be fooled, because these guys, they think they're clever out there. Like yang, you also have yin. This brings me on to my next question that you should ask yourself whenever you're looking to invest in a company, and that is, what is the profit, and are the profits rising? It's basically the opposite of net debt, self-explanatory. You want to invest in a company that's got a really high profit, and year after year the profit's increasing. There are two ways to do that. Most people just think about the sales perspective, but it's not only that. You could also reduce costs, which also increases the difference. You'll find that as the profits increase, the dividends increase. And this kind of brings me back to my third question, because it's a sort of definite, guaranteed yes that the company is doing well if the profit's increasing and also dividends are increasing. It's a very, very good indication that a company is doing well. So you'll find that these tend to go hand in hand, and they tend to go, obviously, progress in the right direction. But the sixth question you need to know the answer to is the market capitalization. This is sometimes shortened down to a market cap, and how that fares with the company's profit on a yearly basis. A lot of people overlook what a market cap is. It's basically the share price of a company times by the number of shares. So if you had 5 shares present in company ABC, and each share costs £10, then it would have a market cap of £50, because it's the number of shares times the share price. Why is this important? Because this tells you how much market that company owns in the stock market. Basically, it tells you its buying power. It tells you the strength, the impact it has on the rest of the market, and that's why it's important. Now, an even better way to sort of use it is when you compare your profit to your market capitalization. So what I do is I get a ratio from the two. You want to divide your profit on a yearly basis divided by the market capitalization. If this number is less than 0.1, you're wasting your time. Don't bother investing in that company. I'm not saying this is a definite yes or no, but what I'm trying to say is this is a sort of guideline. But yeah, if it's less than 0.1, it means that the company is not really that profitable. Yeah, you're taking a risk which doesn't reap much benefit. Whereas if it's 0.1 or greater, then yeah, now we're talking. You want to basically aim for as high of a ratio between using those two values as possible, because that ultimately means that the company becomes more and more profitable. 8th question you should ask yourself is, what does the overall company look like? This is information from news, this is information from people around you, this is information from gurus, from bulletin boards, whatever gives you a perspective of that company. And the final question that you need to know is the share price. What is the trend of the share price? Has the share price gone down? Maybe that's better because you can invest in at a bargain and therefore sell at a higher price. Or is the price a bit too high? Maybe you're scared that it might go back down again. You need to assess that. One thing that I've learned recently is, yes, you can invest in a company, you can do the research and stuff like that, but if you buy at the worst price, you're not going to make a profit. You need to buy at the optimum price, and you want to remember, buy in low and gain high. Another thing that I learned is a company can have all the right things going for it, but there will be a point where that company is overvalued, and you need to judge by looking at the share price, looking at previous history, how the share price has changed from time to time. You need to look at that to judge whether that company is overvalued. Even if the company seems to have the best thing going for it, there will still be a value at which, if the share price goes above it, it will be considered overvalued and therefore not worthwhile investing in. So you've got to assess that, and that's the final question that I would ask myself before I'm looking to invest in a company. Altogether, there are tons of questions that you guys should know the answers to, and the answers should be good answers when you're looking to invest in a company. The ones I've discussed are probably the ones at the top of the list, I would say. But yeah, you guys enjoyed it, didn't you? I know you did. I know. I hope you guys like this week's episode. Watch out for next week's one. It's going to be a banger, you know it. Don't forget to like, subscribe and share. DS Learn and Finance. Whoa. Bye.